to understand tax is about law. And in Nigeria, the highest law in Nigeria is the Nigerian Constitution. Section 24 of the Constitution of the Federal Republic of Nigeria mandates every citizen, and that also includes every person, which can be a company, to correctly declare tax and pay. Then the National Assembly had made various laws that prescribes taxes payable, how they are supposed to be paid, who is supposed to pay, how much is to be paid, to whom it must be paid. Then the governments at the federal level, at the state level, have constituted tax authorities. At the federal level, it is Federal Inland Revenue Service. At the state levels, it is State Internal Revenue Service. And the role of each authority is clearly defined in the relevant tax laws. When we speak about tax compliance, what are we complying with? Essentially, we are complying with the law. And there are a number of aspects of compliance. Number one is you must be registered for tax. You must have a tax file. So if you are an individual, for example, you must have your tax file with your relevant state tax authority. If you are a company or a corporation, or if you are a non-resident Nigerian, but you earn income in Nigeria, you must register with the Federal Inland Revenue Service. That is the first level compliance. There is charging of tax, there is withholding of tax, and there is self-computation of tax, and I will explain. Charging of tax, if we are dealing, for example, with value-added tax, and you are a business person, when you are providing service or you are selling your product, under the VAT Act, the Value-Added Tax Act, you must charge VAT along with the prices of your goods. So you have a charging obligation. Then on deducting of tax, for certain individuals and companies and transactions, the relevant income tax law require withholding of tax. And what do we mean by withholding? It means that if you have provided a transaction and you charge, let's say, 100 naira, and the law wants a withholding of tax. So from that 100 naira, either it is at 5% or at 10%, the person who is making the payment is required by law to deduct that tax and only remit the difference to the supplier. The tax that is deducted is called withholding tax. It's now paid directly to the tax authority. Depending on whether it is an individual, then it goes to the state tax authority. If it's a company or a non-resident individual, it comes to Federal Inland Revenue Service. And a very simple example is what we call PAYE, pay as you earn. When an employer at the end of a period wants to pay his employee, under the law, Personal Income Tax Act, is expected to deduct PAYE, pay as you earn, and then give the employee just the net amount of his payment, net of tax. And the tax that is deducted or withheld is paid to the relevant tax authority. Similarly, there are certain business transactions that require withholding of income tax from the income of a company. So when paying those supplier companies, the withholding tax is deducted, and remitted to the Federal Revenue Service. So that's the deducting compliance. So as an individual or as a company, the law requires that at the end of each year, after you have done your accounts, you must compute your own tax. That's what we call self-assessment. You assess yourself based on your own financials, based on your own transactions, your income, your profits. You assess yourself to income tax. And so that is the process of you computing your own tax. So even individuals are required to do so. As an individual, at the end of each year, you do your Form A, whether you have income from employment, from trading, or from any source. You again, based on the law, you compute your own tax. So you have that obligation. Every individual, every company has that obligation. So that's a compliance issue.